In today's video, we'll continue our pre-earnings analysis, this time taking a look at Microsoft. Microsoft is set to report earnings October 25th, 2022. This is a confirmed date. So we're going to try and analyze the pre-earnings patterns specific to a bear market. Now here's the agenda for today's video. We'll start first with the 5-year analysis. This is where we get to take a look at a total of 20 earnings, but this is not focused on only the bear market years. So keep that in mind. This is a broader picture view of what tends to happen inside of Microsoft. After that, we'll shrink this down to a 2-year analysis, so 8 earnings in total. Then we'll move down to just this past year with a total of 4 earnings. The idea here is to build an earnings personality around both price and volatility patterns. Once we take a look at the 5, the 2, and the 1-year earnings patterns, we'll then move on to technical analysis, taking a look at price channels, the squeeze, the edge signals indicator, things of that nature. And finally, we'll bring everything together with one options trade idea that I think maximizes on all of the different patterns that we've found. For all Volatility Box members, you can download the pre-earnings analysis indicator, which I'll be using in this tutorial for free from our website. I'll leave a link to this URL in the description box as well. Now let's get started with diving into Microsoft. Now coming inside of our thinkorswim charts, let's start with the 5-year analysis first. This is set to a 5-year, 1-day time frame. And in terms of the indicators, I have the pre-earnings analysis indicator, I have the market pulse loaded on, I have the triple squeeze loaded on, along with the edge signals for our overbought oversold indication and the Keltner channels. Now if I click OK, let's start by analyzing the price patterns first for 5 years, 7 days prior to earnings, which goes really on Thursday's candle, but I think 7 is a nice easy number that we can gain a lot of useful insight from. Now starting with the 7-year analysis, price tends to rise about 55% of the time and tends to fall about 45% of the time. So here, no real clues around what tends to happen more often, at least over the past 5 years. On average, that move is exactly the same as well, plus 2.59, minus 2.59. Now we move on to the implied volatility analysis. There's a very clear pattern that stands out. The implied volatility tends to rise about 80% of the time, and on average that's 15% rise in IV, and it tends to fall about 20% of the time with a fall of about 7%. So if we were to gain some patterns from the 5-year analysis here, we don't really have any clues around price directionality, but we do have a very clear clue that IV tends to rise as we head into earnings. Let's see if that same idea carries forward on the 2-year analysis. I'll switch this over to 2 years, and now we repeat the same process. One more time, we see a breakdown of price rising and falling about 50-50, so no real clues there. In terms of the average gain, 3.38%, average fall, 3.4%. So one more time, more or less head-to-head here around the average rise, the average fall, both in terms of tendencies along with the number. Now we switch to the implied volatility. Here, a very clear clue one more time. The IV tends to rise 100% of the time, so 8 out of 8 earnings. And on average, that has been about 15.48% in a rise in implied volatility. So one more time, we're seeing the same pattern come true, with implied volatility being the one constant here that rises. So far we're seeing long volatility headed into earnings is a good idea. Now let's switch this over to just the past 1 year. So now we have a total of 4 earnings. Now here, price tends to rise about 25% of the time, but has fallen 75% of the time. So a little bit more clues here, but fewer data points. In the more recent history, price has tended to fall as we head into earnings. We can see that here, we can see that here, and we can see that here as well. The only one rise we have is the very first one at the beginning of the charts. Now, with that in mind, let's move on to the next portion, the implied volatility. The implied volatility here, one more time, 4 out of 4 times tends to rise, and on average this past year, it's risen about 24.76%, so far greater implied volatility compared to the typical 15% that we've seen. So let's summarize first what we've learned from our 5, the 2, and the 1-year earnings patterns analysis. We've seen price, no real clues around what tends to happen, rise or fall. More recently, we have a bias towards the fall side, but other than that, it's been more or less a 50-50 split. The implied volatility, however, is where we have found a consistent edge that IV tends to rise into earnings, usually about 80 to 100% of the time, 100 being the more recent occurrences. So with that, let's now focus in on the technicals and see what they're telling us as well to try and then craft together a total comprehensive options idea. Now looking at Microsoft, we start first with the price channel. Very clear downtrend here inside of Microsoft. I'll switch back to a 5-year chart so you can see this a little cleaner. So on that down channel, we've really had the top identified here, the bottom of the channel here, and we've bounced in between this channel, now tagging most recently with Friday's activity, or Thursday's activity rather, the bottom of this channel. If I zoom in, we can see price tagged the outer edge of the channel, and we bounced up from there with Friday's activity giving us a slightly better entry compared to the closing price of that large green candle. So far here, we're towards the bottom of the channel, and I would argue that the bias is more towards the upside, given that it looks like we're extended on the downside here, at least based on the price channel. Now we've also seen an edge signal confirmation with Thursday's activity. That green arrow suggests we're officially in oversold territory. So that's another cue or another reason why I would have a more bullish bias here than a bearish bias. In terms of bearish biases, the market pulse very clearly red here, suggesting we're in a stage of deceleration. So that's the one factor going against us on the technical analysis piece. We also have an open gap here around that 240 price point. Above it actually is where the actual gap is, between 240 to 245. And this little gap here is what I'm looking to get filled as we head into earnings. The last thing that stands out is a squeeze that's currently forming. This is the aggressive compression squeeze, which so far is looking like it may fire towards the downside given the histograms are below 0. So those are all of the technical analysis pieces that we have. The key idea here that stands out to me, we have a price channel. We're towards the bottom end of that channel and we've bounced from there. And we've also confirmed that channel with our oversold signal. You can take a look to see what happens every single time we've had an edge signal towards the bottom of the channel. We've bounced away from the actual bottom of the channel. So that's what I'm looking for here as well. A bounce away from the channel, filling this gap, the 240, 245 area. Now let's bring all of this together with an options trade idea. I've already crafted it inside of the Analyze tab. The overall notion here is to buy a long call, and this is a larger or longer dated expiration series. This is November 4th, and that's the 240 call. Sell another call against it. This is the shorter dated series, 28th October. Same idea, 240 call. This is a net debit of $1.48 as of making this video. And if we take a look at the Greeks of this particular strategy, we're able to be long vega with a positive vega exposure. So this means we're long volatility. We have a slight long delta, positive 3 delta. So it's not as strong as, say, buying just a long call. We're able to mitigate a bunch of that delta by selling a call against it, so less directional exposure. Let's take a look to see what tends to happen if volatility here rises in this particular position. We had an average of 15%, so let's say volatility adjustment of 15. We can see the vega still remains positive. As a result of that, our P&L, if the price were to remain unchanged, goes from a negative to a positive. So long delta here is benefiting this particular position with an increase in volatility. Now if price also were to increase to say 240, you can see that number continues to improve. The P&L number here goes from 47 to 67, given that we still have a slight long delta exposure. And if instead of 240, let's say this went down to something like say 215, so the stock crashes, our position here still slightly breaks even. Although it's not anything to say write home about, we're still better off than say buying only a long call option. So this is why I like this particular diagonal. It allows us to be long vega. It allows us to have some directional exposure, but mitigate that exposure by selling a call against it. Now let's also see what tends to happen as we get closer to earnings. So I'll use October 25th. That's the day we have earnings. So if this happened on October 25th with the price crashing, but volatility still rising, this position still wins despite us being long delta. So that's one other thing that stands out here. If say the stock did make a move towards 240, you can see how that P&L number jumps even higher, suggesting that this strategy would benefit from price actually filling the overall gap idea that we were talking about between the 240-245 mark. So one more time to summarize everything we talked about in this video, we have the 5, the 2, and the 1 year earnings tendencies, all giving us not really clues around price, but more so around implied volatility, and that tending to rise more often than not. On average, we saw that number to be about 15%, and that's the number we used as our general basis of what we expect implied volatility to do. Inside of our technical analysis here, we're chopping around this channel. We're most recently towards the bottom end of this channel, and it looks like we're bouncing away from it with a confirmed edge signal move, and we're getting a slightly better entry price compared to the close on Thursday. Using all of that, we crafted a diagonal here. The diagonal consisted of buying the November 4th 240 call, selling the October 28th 240 call against it, a net debit of $1.48. This allows us to be positive vega, if I reset this, positive vega and a slightly positive delta here. And we'll go back to our default price here, and let's go back to our default date here of today. So we have a slightly positive delta, but more so a positive vega, and that's what we're really looking to try and capitalize on this position. As volatility increases, we profit from this position, whether the stock price goes up to 240 or even drops down to that 215, 220 mark, which would suggest a crash inside of Microsoft. Again, for all Volatility Box members, you can download the pre-earnings analysis indicator for free from our website, and I've left the URL in the description box below. Take care everyone, good luck trading, and I'll see you in the next update.